Hello, everyone. In this session, we are going to discuss the basic concepts in accounting theory. To begin with, accounting is built on a set of fundamental concepts. These concepts are very important because they provide a logical foundation for recording, measuring, and reporting financial information. Without these basic concepts, accounting practices would be inconsistent, difficult to compare, and less reliable for decision making. The first concept is the entity concept. This concept states that a business is considered a separate entity from its owner. In other words, the personal finances of the owner must be completely separated from the business finances. For example, if an owner pays personal expenses using company money, it should not be recorded as a business expense. This separation ensures that financial statements reflect only the performance and position of the business itself. The second concept is the going concern concept. This concept assumes that a business will continue its operations in the foreseeable future and is not expected to liquidate in the near term. Because of this assumption, assets are recorded based on their useful life in the business rather than their liquidation because it affects how financial statements are prepared and how assets and liabilities are valued. The third concept is the accrual concept. Under this concept, revenues and expenses are recognized when they are earned or incurred, regardless of when cash is received or paid. For example, if a company provides services in December but receives payment in January, the revenue is still recorded in December. This concept helps provide a more accurate picture of a company's financial performance in a specific accounting period. The fourth concept is the matching principle. This principle states that expenses should be recognized in the same period as the revenues they help generate. For instance, if a company sells products, the cost of producing or purchasing those products should be recorded in the same period as the sales revenue. This helps determine the real profit or loss of the company more accurately. The fifth concept is the monetary unit concept. This concept assumes that all transactions can be measured in a stable monetary unit, such as rupiah or dollar. It means that only transactions that can be expressed in money are recorded in accounting. Although non-financial factors like employee satisfaction or customer loyalty are important, they are not recorded unless they can be measured in monetary terms. The sixth concept is the historical cost concept. This concept states that assets should be recorded at their original purchase cost at the time of acquisition. For example, if a company buys equipment for a certain price, that price is recorded in the financial statements, even if the market value changes later. This concept provides objectivity and reliability because historical cost is based on actual transactions. The seventh concept is the consistency concept. This means that a company should use the same accounting methods and policies from one period to another. For example, if a company uses straight-line depreciation in 1 year, it should continue using the same method in the following years unless there is a valid reason to change. This consistency allows users of financial statements to compare financial performance over time more easily. The eighth concept is the materiality concept. This concept states that only information that is significant and can influence decision-making should be included in financial reports. Small or insignificant items may be ignored if they do not affect users' decisions. For example, a very small expense might not need detailed reporting if it has no significant impact on financial statements. The ninth concept is the prudence or conservatism concept. This concept suggests that accountants should be careful and cautious when making estimates. It means that potential losses should be recognized as soon as they are likely, while gains should only be recognized when they are certain. In conclusion, understanding these basic accounting concepts is very important because they are the foundation of all accounting processes. Thank you for your attention.